Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Jonathan Pingle of UBS is still with us. Jonathan, we've been talking about the effort the Federal Reserve needs to go to get inflation back down towards target. How much of that is being offset by what's happening in Treasury, the amount of issuance we're getting, the amount of fiscal easing we've seen?
Yeah, fiscal policy, in our view, is a huge support to 2023. I mean, we all talked about, the Biden administration programs, the CHIPS Act, the IRA, and we were all watching sort of this extraordinary boom in chip manufacturing, chip plant manufacturing, construction, all the related EV plant manufacturing, construction. I mean, structures investment in 2023 added roughly half a percentage point to year-over-year, Q4 over Q4 GDP. So, 3% GDP, half a percentage point of that was the structures investment. Direct government spending and investment, the public sector investment, add on a little bit of the deficit widening, it's a percentage point. So a third of the growth that we saw, and we generally think of the government as being somewhat, kind of interest rate insensitive, right? So, So this was definitely a thrust that the Fed was forced to fight in 2023 with higher rates that, really wasn't going to be affected by monetary policy.
You keep saying 2023. Can we talk about 2024? How sustainable is that? How much money is still being distributed every single day into the economy off the back of these programs?
A lot less. I mean, if we think about it in terms of growth rates, it's sort of like we moved up the level, and now we've got these wider deficits in this level, but the level now is kind of staying the same for a while. And that means the impact on growth is essentially going to zero in 2024 in our view. And this is sort of a natural way of thinking about fiscal policy, right? And this is why it's counter-cyclical. You widen the deficit in bad times but we've ended up sort of widening the deficit in good times. We've had the growth benefit, and now we've got sort of the wider deficit, and the growth impetus is sort of fading at this point.
As an economist, do you think that the likelihood of the U.S. Treasury Department more heavily weighting the issuance to T-bills makes sense? That basically, you can capitalize on the demand for short-term T-bills, T-bill and chill, what everyone's been talking about, and not lock in 5% yields over a longer period of time. Is that what we can infer from this announcement?
So, I mean, the Office of Debt Management, they are trying to minimize the interest expense for the taxpayer, based on their calculations. And depending upon history and how interest rates may or may not unfold, you do want some mix between bills and coupon issuance. I mean, there was a long debate pre-COVID whether or not the U.S. should term out its debt a lot. And a lot of those models actually don't say terming out the debt is really the most cost-effective thing to do for the Treasury. But a lot of it's pretty uncertain, too, right? I mean, it depends on the outlook for interest rates, inflation. At this point, net interest payments are, more than defense spending. You're talking 3% of nominal GDP is just paying interest. It's almost 20% of federal government revenue. So, that could get a lot worse if rates stay high and inflation stays high, or it can get better if the Fed starts cutting.
I mean, in other words, another way to frame this question is, do you think that the Treasury is making a call that longer-term interest rates are going to go lower, and that this isn't an opportune time to lock it in?
I can't peer into Janet Yellen's mind and actually I can try, but I do think though that the Treasury is trying to balance what they're seeing on the yield curve. I mean, if that's sort of what you're getting at, and I think that's probably an appropriate thing to do for short-term funding needs, right? We certainly have seen in the money markets a reasonable appetite for bills. I mean, you can see that in all of the money that gets parked at the reverse repo facility at the Fed. I mean, the money markets are still relatively awash in cash, high levels of reserves in the banking system. So that would indicate all else equal that there's a lot of capacity for bill issuance there.
You talked about fiscal policy, so there's more money coming out, but there's also more people, which is propping up this economy we're witnessing. How do you see this potentially changing next year?
Well, I mean, I think the budget choices get hard which is one complication. But the presidential election, is a hugely consequential election for fiscal policy. If we think about what's unfolding in tax policy, most of the individual side of the 2017 tax cuts expires at the end of 2025. And because that's written into current law, that is something that Congress and the next administration are going to want to address, because otherwise it's going to be roughly a almost $3 trillion tax increase over the subsequent 10 years. The plans to pay for that are likely going to look very different comparing the Democrats to the Republicans, but that could have a huge amount of impact on fiscal policy as we look out to 25 and 26.
Secretary Yellen got a grilling on this on Capitol Hill just yesterday. I'll bring a quote up from her statement. "We can make these investments while reducing the deficit by $3 trillion over a decade through a combination of smart savings and tax proposals." I want to bring in Mike McKee. Mike, down in Washington, you witnessed some of that hearing, I'm sure, watching the tape being played back. What did you think of the proposals coming out of the administration? How do they do this? Make these investments while reduce the deficit by $3 trillion over a decade?
Well, they haven't put out an exact plan yet, but the important point for the administration is they do not plan to increase taxes on anyone making $400,000 a year or less. Now, Biden didn't mention that when he tweeted that the tax bills need to sunset because the deficit is too high. So there was a big back and forth up on the Hill about whether they would do that or not. Yellen insisting they will do that. But there's going to have to be a way to make up some of the difference between the two sides. Although we are going to have to also see, as Jonathan said, the results of the election, not only who's president, but who controls each house. If the Democrats are in charge of the House and Senate, it's obviously easier to let the tax provisions expire. But if not, then we may end up with a real fight on our hands over how far they're willing to go, both sides.
She really got a grilling on this because when Biden's campaign tweeted about this, he left out the fact that he wants to keep the tax cuts for families making under $400,000. But Mike, does this just come down to the point that they're going to pay for this by raising taxes on everyone else above that threshold?
Yes, what they've outlined in the past is that taxes go up for people above that threshold, of course, on a graduated basis, and business taxes, corporate taxes will probably go up, but they won't go up to where they were before the original tax cuts. They'll go part of the way there. There was a hearing not long ago in which officials from the Biden administration were saying, look, the economy was fine with the tax. We would be fine with tax rates that are a little bit lower, but not as high as they were. We don't have to go all the way back. They'll try to sell it that way.
Jonathan Pingle's still with us, and I am curious, Jonathan, as you listen to all of these proposals, and you listened to Janet Yellen's hearing yesterday and her speech coming later this week, how much dispersion is there about your potential outcomes for the economy based on the divergence in tax and as well as tariff policy between the two candidates?
Yeah, I mean, we've written a fair bit on this, and it's a pretty big gap. I mean, in looking at some of the plans that have been put forward and what we can glean from the campaigns, it looks to us like, essentially a Republican sweep, so if former President Trump wins the presidency and the Republicans take both houses of Congress, that they would want to fully extend all of the tax cuts, potentially have some pay-fors, but also reduce some other taxes. And, the Biden administration, I mean, what you can glean both from, both from the president's budget proposals this year and last year, is, as Mike would say, they would, fully extend the tax cuts for those households making under 400 or potentially 450,000. Let taxes rise back to the old marginal rates for those making over. But then you could also work on corporate taxes, potentially raise the investment tax, and maybe even capital gains taxes for upper income individuals. Those are very different outcomes. I mean, you really are, over a 10-year budget window, talking about, trillions of dollars in differences between, what the deficits would look like under one set of plans or potential compromise or another. And I think we get the historical template for that is the expiration of the Bush tax cuts in 2012, which was very much a similar playbook. The tax cuts expired for the upper income households, were extended for those making under a certain threshold. So we sort of have run this playbook before. before, and we can see what sort of a divided government outcome might look like. But certainly the Republican wave offers a much different fiscal stance, potentially.
When does the deficit matter then, economically? When is it actually a drag on the economy rather than a boost, and this sort of fuel for American exceptionalism?
Well, the deficit in some ways already matters. I mean, we saw last fall, term premium getting pushed around from the refunding announcements as we went from August, through November. And I think we could also make a case that, we're already making choices that are difficult, constrained by our, budget pressures, whether it's our defense spending, our geopolitical posture, our fiscal stance and fiscal position now, I think is already starting to influence policy and the choices we're making for the economy. On
this Fed day, how seriously do you take proposals of eliminating the Fed independence?
Well, I worry. My hope is that cooler heads would prevail. I think, Congress obviously would play a very important role in the ability of any administration through appointees or through legislation to try to alter the position of the Federal Reserve System. But, as a former Fed staffer, I think that, monetary policy independence is absolutely crucial for a well-functioning economy.
But it's mandated by Congress, something that potentially the president, former president, which maybe the future president could do unilaterally, is tariffs. And he talked about this extensively in this sit-down with Time magazine. And he said potentially that ring around the country that he calls it could be more than 10%. And he says, I also don't believe that the costs will go up that much. How inflationary is, say, a 10% or bigger tariff roll around the United States?
Well, if it's on everything, you could imagine that, this is going to feed through, pretty quickly and broadly to consumer prices. It's really going to hinge on, is it everybody? Is it just imports from China? I mean, I think that's sort of the crucial question that we're all trying to grapple with, right? Whether or not they really are going to follow through with this, and whether or not, Congress could have a role in stepping in. They've delegated a fair amount of trade authority to the executive branch in the U.S. through these various provisions, national security, trade, protectionism, et cetera. But, there is also a chance that, Congress could weigh on this issue as well and try to limit the amount and breadth of the tariffs, because it would impact other treaty arrangements that we have.
He can do a ton with executive action, that's for sure. Jonathan, it's good to see you. Jonathan Pingle there of UBS. BMO's Earl Davis writing, quote, the Fed wants to maintain optionality to ease in July or September, but acknowledges the diminishing window, adding tailwinds point to a test of 5% for 10-year yields. Earl joins us now for more. Oh, let's talk about those tailwinds towards 5%. Can you list them?
Yeah, we think there's a high probability and high confidence level that we hit 5%. And part of that reason is there's three components to a nominal interest rate, a 10-year yield. One is your break-even inflation. We see the inflation prints going higher, so break-even inflation should go higher. The other one is your real rate or your tips, and that incorporates a couple things. It incorporates the future view of monetary policy, of which that's changing, especially with the partial pivot that we expect today. So that's higher yields there, as well as the risk premium. And the risk premium is impacted by inflation and supply. So when you have all the components of a yield pointing towards higher yields and wider yields, it increases the confidence level and probability that you get to that level. So that's how we're looking at it. And we do see a test of 5% coming up.
Test is an important word. What about sustaining that level? How difficult might that be?
That's a great question. In the short term, it won't be difficult, but in the longer term, it would be difficult. This is one of the things where we will be buying at 5% and above. And part of the reason is higher yields and the market discounting even higher yields than where the present is in the future in regards to forwards. Higher yields will accelerate us towards the end of a business cycle. It's that reflexivity of interest rate markets. So we don't see us being sustainably above 5%, but we could go to 5.25%. But we do see lower rates by 1 year from this time.
This is something we hear a lot, both on the bond and stock side, that we'll be buyers into weakness, right? We'll be buyers into any kind of sell-off. Are you a buyer now, or are you waiting for that 5% level? Are you waiting to sort of see the whites of a 5% yield's eyes?
No, great question. And actually, last time I was on the show was early March, and we, at that point in time, we were tactically long. We switched that over that time. We are short because our confidence level in hitting 5% is increasing with the numbers that we're seeing, as well as there's other tailwinds behind getting to 5%. You know, if you have Japanese intervention, that's possible treasury bond selling. They're the highest holders of treasuries. So they do have a lot of U.S. dollar on hand, but if they work through that and need more U.S. dollars, they sell treasuries. Combine that with a lot of technical aspects in the market in regards to no one has any higher yield hedges on, to your point in your question. So people will panic as we get there. So we think it accelerates upon itself. So we are tactically short now, and we will cover that at 5% and start going long.
You talk about some of the supply and demand dynamics behind this increasing conviction around 5%. You talk about the potential sellers. I want to talk about the idea of the U.S. Treasury Department. We do get the quarterly refunding announcement in about 40 minutes' time. We'll get some sort of details about how they plan to fund a deficit that is increasing. How much is that playing into your call for a 5% yield?
It's significant. And it's not just the refunding announcement of what the next auction sizes will be, but it's the cumulative effect. You know, last week we had record 2 years, record 5 years, record 7 years, you know, and it's the whole curve of debt that's increasing. So that will definitely have impact. And what we haven't seen in treasury yields is risk premium. And part of what you need risk premium for is increasing supply, because it has an impact on the dollar in the long term. So you want to make sure you're getting a return and your money back. And to ensure that in this environment, you need more risk premium. And we don't have risk premium in yields yet. And treasury supply would be one of the reasons why we do start getting that.
Earl, do you see this competing for capital elsewhere? More specifically, is it competing for capital in credit? Are you seeing any sign of that?
I'm going to answer in two parts. The immediate answer is no. No signs at all. Like, look at the Boeing issue. $10 billion in bonds new supply bonds being issued this week, and $80 billion of bids. There is a lot of cash. So even if it does compete, there's still so much cash there. That was 8 times oversubscribed on one of the largest issues in history of bond issuance. So there's room for it to compete. But to the second part to this question, which is a really good question, is the reason why we see higher tips and higher real yields. When your economy is so resilient and growing so fast, what the Treasury and what the Fed has to do is take the money out of the growth economy to slow it down. And the only way you do that is by having higher savings rates as reflected by your tips yield. So although we're, you know, at highs we haven't seen in probably 15 years around, or we haven't tested the high of last November, we're going to test that as well, but we'll probably make new highs in tips as well, because you have to take money out of the growth economy into the savings economy, and you only do that with higher real yields. I'm
looking right now actually at 10-year real yields, and we're looking at 2.3%, as you said, the highest since last November. As you look out, I mean, there's a real divide about where yields are going to end up. You said if we get to 5%, that will expedite the sort of tumbling down to another level that's a lot lower, simply because it will slow the economy. What is that lower level? How big could that rally be versus, say, not as much as people think, just because there isn't the same kind of disinflation that's down the pipeline in the same kind of way that there was pre-pandemic?
Listen, our call from December, and we said it on surveillance as well, is we see the range of 10-year yields in the U.S. at 5% to 3.25%. So I think a move to 5.25% accelerates that move back to a 3 handle. Do we see it this year? No, highly unlikely. But Q1 next year, Q2 next year, it's a very real possibility that we see 3 handle, 3.5, 3.25. So we do see us possibly testing the lower end again. But first, it takes higher yields to do that, to trigger that.
Oh, you've been absolutely phenomenal this year. I say it every time I catch up with you, just absolutely brilliant. This was a clinic once again. Earl Davis there of Beam Up. We begin with our top story. Markets on edge ahead of the Fed decision. US equities closing out a difficult April with the worst day since January. To discuss, Tony DeSpirito of BlackRock joins us now for more. Tony, you describe yourself as actively bullish. Could you help us understand what that means in practice?
Sure. So, John, what I mean by that is, in terms of the market, I'm pretty positive, right? I think we're in a decent setup. We've got earnings that are growing quite nicely for the first time in a while, right? So, right now estimates are running a little above 3%. By the end of the quarter, by the end of the reporting season, we should be close to high single digits, close to double digits. So I think the economy, I actually think, is doing well. Yes, there's some bumps along the road, but generally the trajectory is quite positive, earnings growth quite positive. So that's good for the market. But where I get really excited is the opportunity for active management. And I think about that as it's skill times the opportunity set, and the opportunity set is dispersion. And right now, I see a lot of dispersion. I mean, I've heard you talk about that this morning. Some companies doing really well, some companies doing really poorly, very big differences in valuations amongst companies. To me, that's a stock picker's paradise. And so that's why I use the word actively bullish about the markets, but particularly bullish about the opportunity set for skilled active managers in this market.
Tony, what do you make of these big moves that we're seeing? Peter Chia of Academy started the week by asking whether 10% was the new 1%, just in terms of intraday moves post-earnings for mega-cap names. What do you make of some of these moves? Just double-digit moves here, there, and everywhere.
Yeah, so you're right. The moves have been quite large. I mean, part of that's like, look, the market has changed a lot. Even though we had a tough April, the market's still up 20% since the October lows. It's still up 6% year to date. And so I think, yes, there's some volatility under the scene. Again, volatility is good for a skilled stock picker, but generally the trajectory of the market is still quite nicely up.
Some people were talking about a rolling recession that's basically cleaned out certain sectors. And then we heard from Max Kettner, essentially, that it's been a rolling Goldilocks and that basically you just have to lean into this Goldilocks narrative. Is that what you see, a rolling Goldilocks that's sort of going through different sectors that right now is highlighting and putting a halo around AI and energy, and we'll roll somewhere else pretty soon?
Yes, I wouldn't use the Goldilocks word, but I do see this rolling, recession recovery, so to speak. And I think that's a lot to do with the dance of COVID, the push and pull, where we've seen, chip shortages, then chip surpluses, for example. We've seen, step changes in inflation, auto costs, insurance, et cetera. And so all that's created this, as you put it, this kind of rolling recession. So 2022, really tough year for technology companies. They responded by cutting costs, and then 2023 you have a better cost base and improving revenues, and you have an earnings explosion, a positive earnings explosion. When I look at the market right now, the market's very concentrated in this Magnificent Seven, so to speak. And if you look at the earnings estimates, the Magnificent Seven earnings growth has been quite high, a lot higher than the rest of the market. And the valuations reflect that. What's interesting is if you look out at quarterly earnings estimates, by the end of this year, the estimates for the Mag 7 versus the rest of the market basically normalize, they equalize. And yet you're paying a lot more for the Mag 7. Now, I think the Mag 7, the earnings will probably come out a little better than what the estimates are, but still, it'll be pretty close to equal. And I think that goes, again, to this idea of the market broadening out and that being an opportunity for stock pickers. And I think we will see that over the next, several quarters.
How challenged is this broadening out thesis, not just from the Fed holding rates where they are, but this idea that we're seeing a consumer that does seem to be pinched? I mean, we're talking about Starbucks, we're talking about McDonald's, we're also talking about Amazon, apart from AWS, highlighting a real slowdown in terms of online purchases. How much do you see that as really hampering an ability to broaden out at a time where there really is a two-speed economy, where there is a growing number of people really struggling?
So I actually think that's a healthy part of the process. What we're hearing, when I speak to individual company CEOs, et cetera, what I hear is a consumer being more selective. And I think that's a function of this step change, so to speak, in prices that we've seen. And I see that as a good thing, because when I look at consumer spending and consumer savings, I see a consumer that's been spending at an above trend rate, meaning the consumer savings rate is too low. It's hovering just over 3%. Normal is much more like 6%, right? And so I like the fact that the consumer is getting a little bit more selective, a little bit more conservative. I think that's good for the long run. The other positive I see that we haven't talked about is just productivity growth and population growth. Both of those have surprised positively, and that's also helping to sustain the economy, even though the consumer is being more conservative.
Tony, you spent a lot of time on your note talking about the election and the fact that actually companies aren't talking about it, even though many are saying that this is the most consequential election in our lifetime. Is that just because these two individuals are known knowns?
Yeah, it's pretty interesting, right? Because we've gone back since the elections, going back to 2012, and using our AI techniques have gone back and read through effectively conference call transcripts, and companies are talking less at this stage. Now, we would expect it to increase as we get closer to the election, but fewer companies are talking about the election. I agree with you. I think it's largely because we have two known candidates. And I don't think we also are going to have, I think no matter how it comes out, we're going to have a lot of close calls, whether that's at the presidency, whether that's at the House or the Senate. Yep. And so I think that means not big policy changes from here.
I think they all understand the pitfalls of talking about politics now as well, Tony. Tony, it's good to hear from you, as always. Tony DeSpirito of BlackRock there.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.